Wow. Good morning. It's me, Kenny Polcari, and I'm here with 2 cups of my favorite Dunkin' Donuts coffee. One I've already had, the other one brand new, nice and hot. I'll have that after we do this. Good morning. I am your host, Kenny Polcari, and today is Friday, January 13th. So yes, it is Friday the 13th, if anyone out there has that trickster-dectophobia, which I do not. But in case you do, today is Friday the 13th, and what do we have to talk about today? Lots going on. Some of the CPI, some of you, we analyze the CPI and we realize maybe it just wasn't what it appeared. And on top of that, we get bank earnings season, and they are just knocking it out of the park. Every one of them so far beating on the top line and the bottom line, and oh, it's all great. But guess what? Loan loss reserves, provisions for credit defaults are on the rise. And what did we talk about, and what have we been talking about for as we approach the earnings season? So we'll get to that in a minute. So what is it that you need to know? Well, was the CPI all that it appeared? And stocks did move up yesterday on the back of that, which was surprising to me. But today, they are moving lower. Banks, like I said, are kicking it off. And guess what? They're all beating on the top and bottom lines, which is kind of interesting. But remember, estimates have come way down. In oil, it's kissing 80. And gold already kissed 1900 and blasted up through. Oh, and the China oil demand story? Expected to be strong, helping oil to move higher. And what do we have for dinner tonight? We're having the Pesce Spada alla Siciliana, right? It's really swordfish Sicilian style. So we'll get to that in a moment. And so it happened yesterday, right? The government reported CPI that was in line with the expectation if you look at just the numbers. Not better, not worse, but directly on target. But when you pull back the sheets a little bit, you see something very different. Services were up 7.5% versus the expected plus 7.2. Ex-rent of shelter services was up 7.4 versus the expected 7.2. Medical care services up 8% year over year versus the plus 7.6 last month. And do you see the common denominator here? It's services. And considering the U.S. economy is a 75% services economy, then the report doesn't look like wine and roses the way it appeared. Now, futures, which are up in the moments, but prior to the announcement yesterday morning, went negative in the minutes after, only to go positive, then negative, and then positive again by mid-afternoon. All the indexes higher by the end of the day, something I had not expected, but they were. Comments by Philly Fed President Patty Harker seemed to give the impression that the Fed might be softening. I don't think so, but here's what he said. And I quote this, right? That rate hikes of 1/4 percentage point will be appropriate going forward. Okay, is that so dramatic? I mean, it doesn't even feel dramatic to me, right? But what does it mean? It means nothing, really. First of all, Patty Harker is not a voting member. And while we do respect Patty Harker for being Patty Harker, he doesn't get a vote. So he could say anything he wants, and it doesn't carry any weight at the voting booth. Additionally, I'm not sure why this is such a big deal. The market has been pricing in a 25 basis point hike for weeks now. We discussed 50 basis points, but the reality is that the Fed and the market has been pricing in 25. So this is not a mind-blowing observation by any stretch. But it is just another observation from a Fed member that is trying to, take everyone off the ledge. Then we get a range of comments from street analysts and portfolio managers who are also looking for the services sector of the CPI to be weaker. For instance, Tommy Koster, who's a senior U.S. economist at Pictet Wealth Management in Geneva, was looking for the trend in services inflation to abate, which would then cause the Fed to reconsider the narrative, to which I might add, clearly, Tommy, that was not true. The report revealed that service inflation was up, and that makes up 2/3 of the index. And so, therefore, the services side is not coming in. In addition to the stats that we just talked about, think about this. Restaurants are paying dishwashers $30 an hour under the table, which equates to about $60 an hour if you're in New York, right? If you had to put them on the payroll, or $38 an hour if you had to put them on the payroll here in Florida. Because in New York, you have to pay everybody plus the feds. So in order for the guy to end up with $30 an hour, you got to pay him $60. He then has to take $30, which is 50% to pay the feds, the state, the local taxes in New York. In Florida, there are no state and local taxes, so the cost to hire that same dishwasher and put it on the payroll is significantly less. But the point is that services inflation is not going down. Dishwashers are part of the service economy. Waiters and waitresses are part of the service economy. Higher food prices and higher costs to employ these people to work are all part of the services economy, and that's where it gets sticky. Hotel maids are part of the services economy. Have you seen hotel rates recently? The Holiday Garden Inn, which is a nothing hotel down on Wall Street in Manhattan, has a 300 square foot room with a sink that you can't even wash your face in, a bed that fits the room wall to wall, along with one bath towel and one face cloth, and no closet. It's just a hook on the wall. And they get $389 a night, plus $125 in various fees and resort taxes. Yes, that's correct. New York City collects a resort tax, which is hysterical. So that totals $520 for one night. Restaurants and hotels are part of the services economy. So tell me, what part of the services economy are they talking about? And forget about the cost of food at those restaurants and hotels. That just keeps getting more expensive as the cost of food is not coming down at all. But thank God used car prices are in decline. Now that's something to write home about, to say, hey, Mom, used car prices are coming down. Now, to be sure and fair, the top line inflation number is in decline, right? We went from 1.6% in winter of 21 to 9.1% by the summer of 22 to 6.5% now in the winter of 23. Like I said yesterday, the 3% that we've taken out of the report was the fluff. So from the 9 to the 6, that's the fluff. That's the easy stuff. The next 4% is really about the meat and potatoes. And you can watch me on Fox Business yesterday with Charlie Payne. I put it on my Twitter where we talk about not only that fluff and what it means, but we also talk about generational opportunities presented by some of the dislocated stocks and sectors that are out there. So you can find it on my Twitter. You can find it on the Fox Business link. By the time the closing bell rang yesterday, we saw that the report seemed to mean nothing to traders, algos, and investors. The Dow added another 216 points, or 0.6. The S&P up 14 points, or 0.3. The Nasdaq advanced by 70 points, or 0.6. The Russell added 32 points, or 1.7%, while the transports gained 100 points, or 0.7%. Now, my friend Ron Insana points out on Twitter, and his handle is @RInsana, that the 3-month and the 10-year Treasury spread is now 1.25%, taking us deep in early 1980s territory, causing him to suggest that something has to give. The Fed, perhaps? The responses were varied, as you might expect, but the overall tone was basically not yet, which has been my stance for months now. I do not believe that the Fed is going to change the narrative just yet. And while they may pause in May, that doesn't mean that they won't begin hiking again if the data doesn't cooperate. And if the data does cooperate, it doesn't mean that they're going to begin cutting either. JJ and his team have been very clear. Inflation is in the bullseye. 2% is the goal. And we are currently at 6%. That's a 4% difference. And that 4% is what's going to be tough to conquer, at least in my opinion. So how are we going to get there? Okay, that was then. Today, it's all about bank earnings. At 6:30 this morning, we heard from BlackRock, BLK. And as you might guess, they beat on the top and bottom lines. Oh my God, $8.93 a share versus $8.08. Revenues of $4.34 billion versus the estimate of $4.25. Fourth quarter long-term inflows of $145.6 billion versus the expectation of $124.4. JP Morgan was due out at 7 o'clock. And what did they report? Well, we're going to get to that in a second. But the bottom line here is that the big banks, the question you need to ask is, what are they allocating to loan loss reserves? What will that tell us about what these banks think about what's next? How deep of a recession are they suggesting or predicting? Which bank will be the one to miss the estimates? So sit tight, because we are about to find out. First out, before JP Morgan, was Bank of America. They reported they beat on the bottom line and the top line. Oh my God, can you believe it? Net interest income of $14.7 billion. Investment banking fees slightly better than the forecast, but is down by 57% year over year. But that was expected. And loan loss reserves? Oh yes, they increased by $200 million versus last quarter. Is that clear enough? Fourth quarter provision for credit losses at Bank of America is $1.1 billion. Now, JP Morgan, they came out right after. They beat on the top and bottom line. Wow, this is unbelievable. What a surprise. Loan loss reserves, fourth quarter provision for JP Morgan for credit losses is $2.2 billion. Delta Airlines just announced, and guess what? Yep, they beat on the top and bottom lines as well. Funny how that happens when they guide the street lower from the earlier higher estimates, but whatever. Now, they offered up guidance of 15 cents to 30 cents in the first quarter, which is lower than the original estimate, and that's due to guess what? What they expect the pilots' union negotiations are going to impose. So think higher wages, right? To combat higher inflation and better benefits. And this goes to my prior concern of spinning into that wage price spiral inflationary cycle. Higher inflation forces employees to demand higher wages, which forces inflation higher, which forces wages higher. It's a vicious circle, and one that can be stopped by slowing the economy down. And how does that happen? Bingo! The Fed continues to raise rates, right? Then they'll slow the economy down, and that wage price spiral will slow down. How many more times are we going to hear that the wage pressure story this quarter? How many other people are going to talk about that? How many other people are going to talk about the cost of employees? So again, brace yourself, right, to get just a little bit more uncomfortable. Again, not a reason to abandon the ship, but it is something to keep in mind. Gavish? Okay. Eco data today isn't going to drive the action. Just FYI. University of Michigan sentiment survey estimate 60.7, which is up from 59.7. Not going to be a driver. 1-year inflation expectations of 4.3%, with the 5 to 10-year inflation forecast of 2.9. Again, you know how I feel about the 5 to 10-year estimates. I think they're completely useless. So much can happen between now and 5 and 10 years out. So, whatever. Oil is up 70 cents this morning, right? Taking us to 79.10 after kissing 79.30. Inching ever closer to $80 a barrel. Headlines suggest that oil demand in China's going to hit a record. Oh, wow. Who would have thought that? Oil is now up and through short-term resistance at 79.05 and is preparing to challenge intermediate-term resistance at 81.30. So let's see if the resistance at 79.05 now becomes support for a further move higher. And gold, yep, ringing the bell. Ding, 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 ding. Opened at 1898. Blasted up and through 1900 to trade as high as $1,912 an ounce before retracing a bit to trade at 1905 by 7 o'clock this morning. What's more to say? I think gold is going higher. This morning at 7 o'clock, U.S. futures were lower and have turned lower even more. Dow futures down 100, S&Ps were down 18, NASDAQ was down 75, the Russell's down 6, and it's all about the earnings and it's all about the bank earnings. Lots of chatter about what these reports suggest about the future. Remember, the bar is low. So anyone that misses, expect them to get really punished. But don't be surprised if the group trades lower today anyway. After the recent rally off the December lows, the Financial Services Index, the XLF, the ETF, is up 9% since the December lows. JP Morgan's up 9%. Bank of America's up 11%. BlackRock up 10%. Wells Fargo up 8%. So don't be surprised if you see some pressure on those as there's some profit taking. European markets are up across the board. They were at 7 o'clock, all up about 0.5%. The S&P closed yesterday at 3983, up 14 points. The CPI will be an ongoing discussion today as a range of street analysts opine on what it all means. Was it good? Was it bad? Are rates going up? Are rates going down? Right? And what's really under the sheets when you pull them back and look? And the bank earnings. Expect lots of discussion around the guidance and those provision for loan losses, because that speaks to what these banks think about where we're headed. Now, if you're a day trader, this is what you live for. If you're a long-term investor, look for the opportunity, if there is one, today. And it might take a day or two to settle out. But look at your best holdings and add to the allocation. If it's rallying, don't chase it. No reason to. You already own it. Let it run. But if some of your names are backing off, then consider adding a bit more. A well-balanced core portfolio is the goal here. You can use cash to play around the edges to add alpha to your portfolio on names that become completely disconnected from the current reality. Again, I don't think the Fed's narrative is going to change, right? I expect rates to continue to rise until at least May. It's now about the earnings season and what that's going to tell us about the economy. In any event, I would expect more volatility at least through May, and then we can revisit what the second half of 2023 might look like, because there's a lot of data between now and then. So that remains fluid. Remember, the tone can change on a dime, and it usually does. So you just have to be prepared. So if you're invested and the tone changes and it gets positive, you're good. Okay, so what do we have for dinner tonight? Okay, so in Italian it's called Pesce Spada, Pesce Spada alla Siciliana, right? So it's really Sicilian swordfish. It's a great dish from this island nation. Well, it's not really its own island nation, but if you ask an Italian from the mainland, Sicilians are Sicilians. They're not Italians, capisci? Which is a whole other conversation, because half of me is Sicilian, the other half is Neapolitan. For this, you're going to need raisins, you need green olives, capers, pinoli nuts, you need tomatoes, garlic, onion, salt, pepper, olive oil, and of course, then you need the swordfish. The dish is easy to make, it's going to tease your senses, and it will tickle your palate. Only takes 15 to 20 minutes or so to prepare, and maybe it's 15 to 20 minutes to cook. Enough time to set your table, pour the wine, light the candles, put on some music, and dim the lights, right? Make it especially, tonight's Friday, so maybe that's the time it happens. Anyway, preheat your oven to 400 degrees. Now, let that heat up. While that's happening, you're going to season the swordfish with salt and pepper and some fresh lemon juice and maybe a tiny splash of olive oil, but just let it season. Next, soak the raisins, right, in warm water for about a half an hour, right, 20 minutes, because you want them to plump up again, right? And so, but make sure the water's nice and warm. Then you want to drain them and just set them aside. Heat the olive oil in a saute pan on medium heat. Right? One that you can put in the oven. You want to saute the diced onions and the crushed garlic until soft. Don't burn them. Maybe it's 5 to 8 minutes. Now add the raisins. Add the diced tomatoes, the chopped olives, no pits, right? You want pitted olives, and the capers, right? Add like 1 tablespoon. And if you like capers, feel free to add a bit more, but too much, you might overpower the dish. So you can always add less and then add more. If you add too much, you add too much. Reduce the heat to simmer, cover it, stirring occasionally for about 15 minutes or so. Let it all blend together. Now, place the swordfish in the baking dish and cover the dish with the raisins, the olive, the capers, and the potato mixture, and then put it in the oven and bake it for 15 minutes or so until the steaks are firm. Present the fish when it's done. Present the fish on a warmed plate with steamed green beans and a large mixed green salad, maybe with red onions, cucumbers, grape tomatoes, maybe some fresh mozzarella. Dress it with salt and pepper, some oregano, a splash of fresh lemon juice, and some olive oil, right, to make a clean, fresh salad. Enjoy that with the Pesce Spada. And you'll have a great meal, right? And a nice glass of wine. For this one, I would choose a white. And you know me, my favorite, Pinot Grigio Santa Margherita. But you have what you like. Chardonnay, I don't drink. If you like Chardonnay, go for it. I prefer the Pinot Grigio Santa Margherita. In any event, it's Friday. The weekend's coming. It's going to be a little bit cool here in Florida, but that's okay, actually. Sleep with the doors open. And until Monday, take good care.